we expect over 100% growth in Massachusetts each quarter this fiscal year. Next, I want to look at another slide in the supplemental earnings deck, slide 4, where we talk about mix shift. Mix shift has been a big focus of ours at the company, and we have a goal of getting our vape revenue below 50%. Obviously, we're still growing that as a percentage. We expect that long term we can decrease it and reach our goal. However, in Q2, 69% of our sales were from vape. We were pleased to see that 11% of our sales came from our energy and natural products division, and the primary driver behind that was natural products. We entered into a new partnership in October-November timeframe of last year. The company that we began working with was generating only around $100,000 in monthly sales, and we're pleased that we were able to grow that to the point where in February, the last month of Q2, we reached almost $600,000 in sales of natural products. We're seeing demand for that category increase across the board, as well as our positioning with our new partnership. Over the last 12 months, we've had 20 customers spend more than $500,000 with us, 10 customers spending over $1 million with us. The full breakout is here in the cross-sell progression slide, where we see customers spending more money with us, moving up higher into different buckets, and doing that by way of cross-selling. We see that customers that are spending over $1 million with us on a last 12-month basis are buying, on average, 70 SKUs from us. That's a huge metric that we like to track because it shows us that we're going deeper and wider with our existing customer base. We're able to generate more dollars. We're able to enhance and increase our margin, and we're able to make a stickier relationship where it's more defensible long term. Next, I'd like to talk about working capital. First, I want to refer to our balance sheet and have a few call outs there. Number one, cash improving from Q1, cash of $3 million to Q2 ending cash of $17.9 million. This was mainly driven by the registered direct offering we did in January with $31 million in net proceeds. And we were able to take some of that cash and we were able to put it into inventory. And you see inventory growing from $17.4 million at the end of Q1 to almost $36 million at the end of Q2. We loaded up on inventory. Chinese New Year happened right near the end of our Q2, and we wanted to make sure we were prepared with enough inventory to continue our aggressive sales goals through Q2 and into Q3. Next, I want to talk a little bit about the nature of our business. As I talked on previous calls, this is a working capital intensive business. We have to constantly be buying more inventory as our sales continue to ramp at a rapid pace. We're buying product for sometimes 2 to 3 months out because of the lead times and transit times. And we're having to buy product at, if it's 2 to 3 months out, somewhere between a 30% or 50% increased rate. So we're buying more product than we're selling today. And as a result, we're going to constantly be in a negative working capital scenario. Now, we'd like to fix this working capital scenario with less dilutive measures. And there's really 3 primary ways that we can do it. Number one, we can work with our current vendors and factory partners, and we can get better credit terms. And we've been doing that, and we're making significant progress there, including recently, as a few weeks ago, receiving credit terms from our biggest vendor, and those will start to go into effect here in the coming weeks. We are going to continue that initiative while also looking at another way to solve it, which is leveraging debt financing and credit facilities. We currently have $36 million in inventory. We've got over $10 million in receivables, and we're only leveraging $4 million to $8 million on our current credit facility. We know that the assets justify a larger amount of credit than is available to us today. But one of the things that has been working against us is the banking environment around cannabis. We see that improving. We see larger funds now coming to the table wanting to talk about credit facilities. These aren't your traditional bulge bracket banks yet, but we believe with continued progress in Congress and with the SAFE Act, that not only is it going to open it up for larger traditional lenders, but ultimately it'll completely open up banking for the largest of the banks in the country to be able to start working with companies like us that are in the cannabis industry. So we remain very confident that we're going to be able to improve our debt financing relationships here in the coming future. And of course, the third way that we can fund this working capital is through equity investment, and we've utilized this in the past. We will continue to utilize this as necessary in the future, because the last thing we want to do is slow down our growth. But we recognize that of the three ways that we can offset our working capital demands, equity financing is the most dilutive. And so we would prefer to leverage ways 1 and 2 prior to going to 3, but we're going to continue to do whatever is necessary to grow the business at the pace that we're growing. Now, we've also made some internal changes that have been incremental in improving cash flow. Wanted to go through those really quickly. Number 1, we were able to discontinue free shipping as of March 1st. We were able to reduce costs on many of our top-selling items, including recent cost reductions we received a week ago on some of our top-selling SKUs. We were able to reduce our percentage of cash tender that we receive. Handling cash obviously has a high expense to it, and we're seeing more of our clients be able to access credit unions and banking facilities, and that translates to a cheaper cost of cash handling for us as we're able to get payment in wire and ACH form. We're also optimizing our warehouses to make sure that we have stock inventory across all our facilities. This will start to reduce and eventually eliminate unnecessary cross-country or cross-region shipments, as we can ship from the most efficient warehouse. But we've also implemented an initial round of tariff supplement fees. This is a very small start, but it's something we will continue to expand upon as we look to offset the tariffs in hopes that the tariffs will eventually go away altogether here at some point. And lastly, we've started implementing mandatory take clauses in some of our customer agreements. So we've had customers that have ordered custom product. We've had it at our warehouse, and now we're requiring that that product be shipped within a certain time frame so it doesn't tie up a ton of capital sitting on our shelves. Now I'd like to quickly address our Q2 gross margins. Gross margins has been a big topic on previous earnings calls, and we're very pleased to see margins going in the right direction as we continue to execute on the strategic initiatives that we've touched on in the past. We do break out a non-GAAP table. You'll see here that we've adjusted for non-reoccurring air freight costs, we've adjusted for non-reoccurring product quality costs, and we've adjusted for Section 301 tariffs. Now, right now, we've talked about in the past air freighting, and we've talked about product quality issues, and we've done a lot to be able to improve in those areas. We believe that you'll see some impact in Q3, but it should be dramatically less, and you should see relatively no impact in those areas in Q4. So that's all going in the right direction. Now, the biggest drag on our margins is actually the tariffs. We paid almost $1.4 million in tariffs in Q2. None of that was offset by any tariff supplement fees charged to customers. So we ate that. We did that strategically, as we've been doing, to continue to maintain and grow market share. It's an investment. We are looking at offsetting it. As I mentioned, we've implemented some tariff fees. There's probably more to come. We're going to continue to look to recoup this incrementally in Q3 and Q4 with the hopes that the tariff war is going to end very soon. Now, we have also filed for an exemption on tariffs for some of our core items, and we do believe that on these core items, we are entitled for that exemption. Should we be able to receive that exemption, we would actually be able to go back and recoup these fees that we have paid for those specific products. We maintain our goal of getting our margins back up to 30%, and we believe because of this, we're well positioned to achieve our goal of getting to profitability by fiscal 20. Next, I'd like to look at some of the strategic moves that we've been making. We've been making significant investments to get the company to a certain scale. We're starting to get to that scale, although more scale is coming as we continue to grow revenues. What this scale is doing for us is it's increasing our purchasing power, which is allowing for cost reduction. It's also eliminating risk of clients trying to go direct, as we're having such a great price with a lot of these new vendors that we can sell to not only customers, but other distributors because our scale is allowing our cost reduction to go beyond further what other folks are able to get if they go direct. We're also seeing operational efficiencies. We are now optimizing our warehouses. We've implemented Manhattan WMS system into our main warehouse hub. We're seeing significant cost savings already from that. An impact for that will likely be in Q3 and continued impact into Q4 as we roll out the WMS system to our other facilities around the country. And because of this scale, we're also able to garner exclusive and semi-exclusive opportunities, including joint ventures. And we're going to look to continue to take advantage of those as we can. We know we have one of the best footprints in the industry. We've got the largest sales force out there. We've got relationships with all the key clientele. And as a result, folks that are coming to market with products are coming to us first and giving us exclusive or semi-exclusive opportunities to distribute and sell those products to the marketplace. We're also developing our new products with our Coletto division. We have several products that are rolling out here in Q3 and throughout the rest of the fiscal year. These products are going to be highly innovative. They're going to have IP. We're going to be able to maintain higher margins, and we're going to be able to get customers who, some of these products have been designed specifically by and for customers. We're going to be able to get committed long-term volume contracts from these customers. And lastly, we're going to continue to stay focused on growing our core business. Our core business is really lining up. The opportunity is huge if we just continue to execute. We have all the pieces in play, but we're also building out an extremely valuable network. And as we're monetizing it through our core business, we're also examining other ways to monetize that same network. And we believe that we should have some strategic business units evolve out of our current strategic planning where we can better monetize the network we've worked so hard to develop. So what does all this mean? It means that you should continue to see revenue grow organically at a very rapid pace. You should start to see SG&A as a percentage of revenue start to decrease, headcount as a percentage of revenue continue to decrease, and you'll see net losses continue to decrease each quarter as we track toward our goal of profitability in fiscal 20. Next, I want to talk a little bit about our sales pipeline. We believe that we're in a great position with our current infrastructure. We believe that our sales force, having boots on the ground in all of these key markets that are actively developing relationships with key players, is a strategy for success. We're seeing that success. We're winning new business. We're getting our current customers to buy more different products from us. We're ultimately in a position to be a first mover in every single new market as it comes online. We're growing revenues at a very rapid pace, and the revenue growth that we're seeing is primarily organic. Because of this continued revenue ramp, because of the sales pipeline that we see in front of us, we are very confident in raising our fiscal 2019 revenue guidance from where we were at 110 to 120 million up to 140 to 150 million dollar range. And we believe that we can accomplish this revenue growth on an organic basis. So if we look at doing any M&A activity, it would only be on top of this robust growth. Next, I'd like to comment on the restatement of our past financial reports. As noted in our press release issued on April 9th, the company announced its decision to restate its prior period financial statements for interim annual periods within fiscal 2018 and 2017 for non-cash items related to its acquisitions of CMP Wellness, Summit Innovations, and the Hybrid Creative. While the restatement did result in adjustments to the company's historical operating results, the adjustments did not have any impact to the company's net revenue, gross profit, or cash flows from operations for any of the restated fiscal periods. As we enter into M&A deals, we typically enter into an earn-out structure whereby the acquisition price is directly tied to the actual performance of the asset post-acquisition for some period of time. As the stock moves up and down during these earn-out periods, we have to accrue as a liability against where we believe the earn-out metrics will land at the end of the earn-out period. Previously, we were not accruing for this liability in accordance with GAAP standards. I would like to note that this error was identified by our new CFO, Mr. Chris Tedford. Unfortunately, our previous finance team and technical advisory consultants missed this issue in previous periods dating back to May of 2017. I commend Chris and his team for flagging this issue and working swiftly to make the appropriate corrections while addressing it head on. As we continue to mature as a company, while striving to be best in class in all areas, it is extremely important that we continue to upgrade our financial controls and overall compliance. To this matter, we have retained a national accounting advisory firm to assist the company in developing and implementing its internal control structure in accordance with COSO and SOX 404. In addition, we have been working with legal counsel to ensure the company is operating with the utmost compliance, including making upgrades to our KYC policy, restricting sales from certain geographic areas, and requiring verification of license status for hazmat delivery items. Lastly, I'd like to take a couple minutes to address the future outlook. First and foremost, there's plenty of opportunity in some of these emerging markets. I touched on the growth in Massachusetts. We're seeing tremendous growth in Michigan as well, a state that just voted for adult use. We think that the Northeast as a whole is going to be eventually bigger than the California market. Obviously, we're seeing significant success in California, and so opening up the Northeast is going to be huge for our business. Canada is a market that began adult use sales in October of last year. It's been a fairly lumpy start. We're seeing that in our numbers as well. But the underlying trends are great for Canada. The LPs are really stocking up. They're starting to prepare for not only the robust recreational growth that they're seeing in Canada, but also some of the international markets that are opening up. So we remain very bullish on the Northeast opportunity. We remain very bullish on the Canadian opportunity, and we're very excited about the upcoming opportunity in Michigan and the Midwest. In terms of at the political level, we had a big win with the Farm Bill recently passing. That has really sparked a huge opportunity for CBD. We're seeing a lot of the customers that we were working with in CBD start to grow their volumes. We're seeing a lot of the customers we were working with in THC start to move into CBD. We have opportunities in CBD for, of course, packaging, vaping, also our energy and natural products division, specifically ethanol, and also with branding services through our hybrid creative. There's going to be a lot of CBD brands looking to launch or reinvigorate themselves in light of this Farm Bill. We're seeing other positive progress at the federal level. The Safe Banking Act is something that is going to likely get approved, in our opinion. We think that this would unlock a lot of the banking that we're not having access to today, and it would also unlock the major exchanges for companies like us. We're continuing to make progress in listing the company on a major exchange. It's something that we're working on an ongoing basis, and we do remain confident that an uplisting will occur in the coming months. We also are looking at M&A again. We know that our position is very strong, being a market leader with access to capital, but we're seeing a lot of the smaller companies that have been underfunded start to look for exits. They're coming to us. We're able to structure accretive deals. We may do some M&A. We don't expect it to be anything that's gigantic from a revenue or size opportunity, looking at things that are strategic, putting us into accretive categories, putting us into accretive markets that we're not as strong. And we believe with our position that however we structure these deals, we're going to be able to get an arbitrage effect in our multiple. At this point, I'd like to turn over to Chris Tedford to discuss the fiscal Q2 financial results.
Thanks, Nick. I will now turn to our second fiscal quarter 2019 financial results. Total net revenue increased 240% to $35.2 million compared to $10.4 million in the second fiscal quarter of 2018. The increase in net revenue was primarily due to increased selling of vape hardware and accessories, energy solutions, and natural products. On a GAAP basis, gross profits increased to $4.5 million, up from $2.9 million in the second quarter of 2018 due to an increase in overall sales. Gross profit as a percentage of net revenue was equal to 13% in the second quarter of 2019 as compared to 28% in the same period a year ago. This decrease in gross profit is primarily due to a higher sales concentration of vape products, which generally have a lower gross margin, as well as some air freight and product quality costs that we view as short-term in nature, along with the negative impact from the second round of China trade tariffs. As we've communicated on prior calls, we've implemented several strategic sourcing initiatives to address these supply chain challenges. However, based on the timing of when our products sell through, the related financial impact will not be realized until the back half of fiscal 2019. On a non-GAAP basis, excluding the impact of these recent supply chain issues and the current trade tariffs, adjusted gross profit was approximately 20%. As of the end of Q2, total inventory was equal to approximately $36 million, as compared to approximately $12 million as of the prior fiscal year end. The recent ramp in inventory is due primarily to a build in inventory leading up to Chinese New Year and to support our Q3 sales goals. SG&A expense increased to approximately $19 million versus approximately $13 million in the first quarter of 2019, primarily due to an increase in salaries and benefits, including non-cash stock-based compensation expense, facilities costs, and professional services fees. The increase in SG&A reflects the company's focused investment in solidifying its operational platform to allow it to properly scale the business and to support its long-term growth projections. The company expects its headcount and other SG&A expenses to flatten in the back half of fiscal 2019, leading to better leveraging of its cost base. On a GAAP basis, net loss for the second quarter of 2019 was $8.9 million, or negative 10 cents per share, as compared to a net loss of approximately $7.6 million, or negative 12 cents per share in the second quarter of 2018. On a non-GAAP basis, excluding the impact of the non-recurring charges previously discussed, as well as other non-cash items, our net loss for the quarter was approximately $7.8 million, or negative 9 cents per share. We ended the quarter with a cash balance of approximately $18 million, as compared to approximately $3 million as of November 30, 2018. With that, I'll now turn the call back to the operator for the Q&A session.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. And one moment, please, while we poll for questions. Thank you. Our first question comes from the line of Paul Penny with Northland Capital. Please proceed.
Great. Thanks, guys, for taking my question. Hey, Nick and Chris. Can you give us, Nick, some more color around your aspirational, the cadence and timing in order to get there?
Sorry, you cut out, Paul. Can you repeat that?
Yes, sorry. I was asking about gross margins, and if you can give us color on the cadence and the timing in order to get to your aspirational 30% margins. Can you give us more color on that?
Yeah, absolutely. Thank you for the question. So, look, we're pleased that we're going in the right direction. Obviously we break out the non-GAAP table, which would show, where those margins would be if we had some of these non-reoccurring expenses, and the main one there is tariffs. So that timing on tariffs is somewhat out of our control. I don't believe we can get all the way to 30% with those tariffs unless, of course, we're able to fully offset them with tariff supplement fees charged to our customer. And like I said, we plan to do that incrementally over time while hoping that the tariffs go away altogether. But I would say, you should continue to see incremental improvement. Margins should tick up each quarter, Q3, Q4. And then really, the 30% goal is built into our fiscal 20 plan, which, is one of the enablers allowing us to get to profitability in that fiscal year.
Okay, great. And kind of a high-level question in terms of changes in the marketplace, in terms of competition, and specifically, with Green Lane coming to the public markets, can you give us a feel for how much you overlap with them?
Yeah, and it's great to see Green Lane being approved by NASDAQ. There's obviously some precedent there to open the door for companies like us. However, the businesses are vastly different. Green Lane does focus on a completely different clientele. Most of their sales are to smoke shops and head shops and lifestyle stores. And they also sell tobacco products, throughout the country, including jewel products. So we don't do any tobacco. We don't do any of the, consumer devices, bongs and pipes and things like that. We don't sell any of that stuff. We also don't sell to any smoke shops or head shops, which, are federally legal customers, even though the businesses we sell to are great businesses and they're fully compliant on a state level. Our customers are all in the cannabis and CBD industry, and for the most part, they are technically in conflict with federal law because of the federal illegality around cannabis. Now, Green Lane does provide some packaging products to the same customer base that we're targeting, and so there is a little bit of overlap in the businesses. But for the most part, the businesses are pretty different, in my opinion. And I think, it's exciting to see them progressing ahead because it is a cannabis B2B business, and that is going to be listed on the NASDAQ. And that's obviously a goal for us. And so kind of hoping to follow in the footsteps there here in the coming months.
Great. And a question for Chris, on the heels of the accounting changes of late, maybe give us a feel for some of your near-term and intermediate-term priorities, and maybe some of the recent other hires you've bolstered your accounting team with of late.
Sure. Yeah. Thanks, Paul. Yeah, absolutely. Near-term priorities obviously are related to our SOX compliance. We did note out there that we have hired a national accounting advisory firm to support the company with their voluntary SOX compliance and firming up the effectiveness of our internal controls. We do look to continue to upgrade the financial talent of the team. We'll be looking to build out the internal audit department along with some other more technical folks.
Okay, great. Thanks, guys. Great quarter.
Thank you, Paul.
Thank you. Our next question comes from the line of Vivian Azer with Cohen & Company. Please proceed.
Hi, good afternoon.
Hi, Vivian. Good afternoon.
So my first question is on the strength of the revenues in fiscal 2Q, quite impressive, meaningfully ahead of what we were looking for. Any specific call-outs in terms of drivers of upside relative to your internal expectations, either by geography or by category?
Yeah, we remain pleased with the growth in California. I think we're seeing some of the growth slow a little bit around the flower packaging, which has impacted our packaging category, and it's due to some of the rules here. But what we're seeing, obviously, is vape continuing to be very strong, especially in California. So I'd say that's the biggest driver. And then Massachusetts, starting to become a real market with the opening of rec there in November of last year. Like I said, Michigan was pretty surprising to us, growing 150% basically from, or actually it was 215% from Q1 to Q2. So Michigan is interesting. I'd say just across the board, I mean, even the medical states, which we don't break out, seeing tremendous growth there, 500% year over year and 75% from Q1 to Q2. So I'd say it's holistic for us. I'd say the other big thing is the customer base. It's a longer sales cycle getting into some of these larger players, the multi-state operators and the Canadian LPs. So we've seen some of that start to roll in Q2. That should only ramp as we move to Q3 and Q4. And there's some big stuff we're working on in Canada that, you know, we've been working really hard and put in a lot of effort, and we won't even be recognizing revenues until Q1 of next fiscal year, but these are massive projects. So I would just say the kind of the three highlights would be obviously vape, you know, these markets that I called out, and then also the mix shift of our customers into these larger players.
Perfect. That's really helpful. And then as we think about the positive revision to your full year revenue outlook, does that really just reflect the strong momentum that you've seen in your core business in the first half of the fiscal year, or is there any of CBD embedded in that upside?
Yeah, it's mostly due to what we saw in the first half of the year and some of these custom projects that we've been working on. So when we're working with some of the larger players, it's typically not stock items. So we're either doing branded items, which you know, take a little bit more time, or we're doing complete custom builds of proprietary packaging products, and that takes a significant amount of time. But once we get it rolling, presumably that would be very long-term, you know, reoccurring business. So I think that's, you know, one of the things is obviously the numbers from the first half. The other thing is the pipeline, given some of these projects that we're working on. And then, of course, there's some incremental added upside, like the performance of the natural products, which is really taking off. And so we've modeled that out to be bigger in the second half than we had originally thought. We also got off to a slower start with our paper cone joint venture due to some issues that we were having getting that production up and running. And so as we see the quality there start to improve, we're now able to count on those numbers as well on the back half of the year. So a few of those things as well driving this. But yeah, I mean, it's just coming at all angles and new markets, new customers, existing customers. So we felt pretty confident to be able to raise that guidance.
Okay, that's really helpful. And then just last one on the gross margin. If I heard you correctly, you eliminated free shipping March 1. Can you offer any color on what kind of gross margin lift, you know, that alone could have?
You know, I think we were looking at a couple percentage points, 2 to 3 percentage points, and you know, what we did in terms of eliminating that. You know, we've been measuring the impact since March. So there's been, you know, very minimal impact to sales. It's only affected us a little bit on our online sales, which is a small portion of our overall sales. And so, you know, it's great to see that, you know, there's been little impact. And I think ultimately, you know, 2 to 3 points is kind of where you can model on the free shipping throughput.
Perfect. Thanks very much. Congrats on a good quarter.
Thank you, Vivian. Appreciate it.
Thank you. Our next question comes from a line of Aaron Gray with Alliance Global Partners. Please proceed.
Thanks for the questions and congrats on the quarter. Great to see the top line momentum continuing.
Thanks, Aaron. Appreciate it.
First question I have, just want to dig a little bit deeper into California. Great to see that sequential momentum continuing there and actually accelerating. So can you just give some color in terms of what you're seeing in the industry? I know that's somewhere where we've seen a lot of, you know, battling with the black market and it hasn't evolved as much as some people have liked, but you guys are doing quite well there. So just any outlook there and what you guys are expecting going forward in terms of sequential growth this year and how much that can continue into next as you continue to see the black market kind of, you know, slow down and legal sales kind of increase? Thank you.
Yeah, I think the California opportunity remains, you know, very large because of this dynamic that you're describing. The black market is still hurting legal businesses. One of the big issues, in my opinion, is the lack of legal licenses for retail. One of the things that's really helpful to offset that is the, I guess, the law that allows for statewide delivery. That law was under a lot of threat. Seems to be okay for now, although it is facing lawsuits from certain cities. But as long as these licensed retailers are able to deliver to any region in the country, now a lot of these folks are building out these delivery networks today. They're not necessarily in robust existence. They can effectively compete. I think it's about access, right? If you're going to have somebody force them to drive 30 or 40 minutes to buy legal cannabis when there's a black market store, black market dealer, you know, within a 5 or 10 minute drive, it's a very hard sell, especially when cost is cheaper at the black market outlet than it is at the legal outlet. Now, I think as we get more accessibility, more retail licenses, more opportunity for legal delivery, that's going to ultimately continue to drive the momentum in California. The other problem that we're seeing in California is, a lack of clean flower, and so that's put a little bit of a damper on the flower sales in the market. But that should correct itself. The state's finally now was able to extend some of the temporary licenses, and also is starting to approve some of the permanent licenses. So there's a big infrastructure that's required here in the state, and it's just going to take a little bit of time to get it all in place. And I think, the battling the black market, it has to be a two-pronged approach. It has to be licensing more legal businesses that can help compete on a free market basis, combined with enforcement and legal action against the illegal business. And it seems that there's momentum in both of those fronts, but still a lot of work to be done. And I think that's why when we look at California, it's going to be steady growth here for a while, because it's something that's going to continue to improve, but it's not going to change overnight.
All right, great. Thanks. That's helpful. And then just one more question in terms of the long-term supply agreement that you guys announced earlier this year. Just any color you can give in terms of, those partnerships, whether or not they're, here in the U.S. or in Canada. And then also in terms of potential margin impact and any detail you can provide on the product mix and what we can expect from a margin perspective there.
Yeah, so those supply arrangements are in motion. Some of those customers are actually ordering, and orders are ramping. Some of them we're still in R&D, and we're going to be coming out with products soon that will start to have an impact to the top line and bottom line. In terms of margins, obviously at these volumes, the margin gets a little bit tighter, but we can be much more efficient. So as we've talked a lot about margins, there's a difference between direct material margin and, our reported margin. And a lot of that extra operational expense that's going above the line is due to a fast-moving environment where things are dynamic and changing, and we're having to react rapidly and try to satisfy customer needs. In these larger supply arrangement deals, it's a lot more planned out, and so we can prepare for that and be more efficient. One simple example is for our vape products, because they're turning so high, we're air shipping a lot of those in. Well, if we can lock in these type of contracts, then we can take those products and put them on the water and ultimately be able to reduce our cost of freight getting those here to the United States. So even though the direct material margin on some of these larger contracts is going to be less, obviously these customers would expect that because they're spending a lot of money with us. We can be more efficient with how we deliver and essentially offset that impact and still maintain a margin that's within our expected range that will allow us to continue to track toward our expected goals.
All right, great. Thanks, guys, and congrats again on the quarter.
Thank you, Aaron.
Thank you. Our next question comes from the line of Brett Hundley with Seaport Global. Please proceed.
This is Luke Perdo on for Brett Hundley. There's been some larger MSO deals announced in recent months. We would expect such consolidation to broadly be good for your own business. But can you guys take us behind the scenes a bit and talk about the conversations that happen after these announcements take place? Are any companies solely focused on price concessions? Do you find that there are numerous opportunities to take share from your competitors? Is there a discussion about changing packaging types? Any color on this would be really helpful.
Yeah, certainly a lot of activity now here in the U.S. We saw the same type of activity happen in Canada in years past. So it's to be expected, further consolidation. The big difference between the U.S. and Canada is it's going to be very difficult to become really consolidated in the U.S. due to the difference in the state laws and the lack of ability to do interstate commerce. So expect it to still be a fragmented market, even though some of these multi-state operators are going to continue to gain size. Now, in general, this plays to our advantage. We compete against the people that know the cannabis industry, that have the right product set to service these operators. They're all small. They're all pretty much companies that have been growing organically and recycling their retained earnings, not raising outside capital, not building robust infrastructures. And so as these companies consolidate and get bigger, they outgrow those types of providers, and that plays, right into our hands. Fortunately, the companies that do have infrastructure, especially on the packaging side, they just don't have the knowledge. They don't have the right products. They don't really know how to provide comprehensive solutions yet for this industry. So we're in a great spot, and as a result, that's why we're getting so much business coming our way, and our pipeline is so robust. Now, we are dealing in Canada as well, which is a market that is much more consolidated. It's obviously a market that's legal nationally, and so they don't have the interstate commerce restrictions, and we see a totally different type of customer up there. So on one end of the spectrum, you have your large Canadian LPs who are, very well funded. They're looking for the most, efficient costs on all of their goods, and they've got, robust purchasing and procurement teams in place, and they're planning. We're doing projects right now for vape items and beverage items, packaging around that and different hardware. And that stuff's not even in the market yet. It's expected to be in the market in October, but that's just an expected date. And yet they're going hard right now in preparing all of these products. So that's one end of the spectrum. And if we're able to play there, that's great, because eventually the U.S. is going to start to look more and more like that. Now, the complete other end of the spectrum is the guy that still calls us on his phone because he needs to order another, 4 or 5 cases of jars, right? And we're able to basically service the whole spectrum of the customer base, while seeing a lot of the customers move more into a sweet spot where they become a little bit more efficient, and we're able to do higher volumes of business, but we're still able to provide a comprehensive solution. And keep in mind, in cannabis, a lot of these operators, they may already have, scale on certain items, but they're launching new items. They don't have, they may be strong on flower, but not on vape. They might be strong on vape, but not on edibles or pre-rolled joints. And so there's always new opportunities as well, where we can get our foot in the door. And then as we provide exceptional customer service and high quality products at competitive prices, that lends to cross-selling. And you can see in the metrics that a lot of these larger customers that are spending over $1 million with us are actually buying more items from us. So there's a convenience factor in it as well. So I would say, to sum it all up, this trend that you've identified today and for the foreseeable future is working really well to our advantage. And certainly we're going to continue to monitor how we create a lot of value as the marketplace changes.
Thank you for the added detail on that. And maybe as a follow-up, are you seeing producers becoming more focused on their cost expense lines from a staffing and talent standpoint? How well set up do you think you are for what ultimately could be a bigger volume opportunity ahead, but also a more sophisticated buyer?
Yeah, I mean, look, if you talk to any of these guys, they're all going to tell you it's still the second inning, it's still the third inning. I mean, it's very early days. And, I would say, it's a unique scenario where a lot of us as businesses went public at a very young age because we don't have a venture capital market like they do in tech, where you're able to stay private and raise, hundreds of millions or billions of cash and continue growing your business at a rapid rate. We're in a weird situation here in the cannabis industry where everybody's gone public to raise capital, but as a public company, you also have a quarterly report where people are focused on numbers. So, of course, there's going to be some focus from these public companies on their bottom line and making sure that their costs are efficient and accretive. But you're crazy if you're in the cannabis industry today and you're focused on making money and not grabbing market share and building a sustainable global brand. And that's where our customers should be focused on, and that's where a lot of them are focused on. And ultimately, if there's a reliable supply chain partner that can take care of a lot of these things that, spin your head and take away bandwidth, why not utilize that and then take your resources and your bandwidth and your internal folks and focus them on sales, marketing, and building brand and building infrastructure. And again, I think, it's the smart thing to do, and it's what we're seeing in the marketplace.
Thank you. And just one more here. company give us a sense of what proportion of its portfolio is commoditized and what proportion is more value add, either through distinct supply relationships or IP added by the company prior to resale? And what's a realistic target for this mix over time?
Yeah, that's a great question, Brett, and it's something that I think is often missed in our story, and people look at us and say, oh, well, can't anyone do that? And obviously the answer is no, or else more people would be doing it. But there's a lot of underlying reasons as to why, and one of them is our intense focus on building proprietariness to our business. We're doing it in virtually every way that we can think of. So all we do, right, we have a business model that's working extremely well, right? We're winning business. We're taking care of our customers. That's easy blocking and tackling. So all we do as a senior leadership team is focus on, okay, how do we make this defensible? How do we defend against the competition of the future? And of course, one of the best ways to do that is to continue to innovate and be an innovation leader. So we started our Coletto division not too long ago. They've been very focused on bringing products to market. These are going to be proprietary products where we garner IP. These products are going to either be for mass market sale or they're going to be specifically tied to certain customers. Now, unfortunately, when there's a very large customer that wants to spend, $10 million, $15, $20 million annually on a custom project, we prioritize that. So we've been pulled in a lot of different directions, but we have our own products launching soon. We have some of these custom projects for customers launching soon. So we're doing a lot on the product side for packaging, and we're garnering a lot of IP. And so I don't have an exact percentage. We have products that we're selling today, some of our top sellers that are unique and proprietary. But as a whole, we still have a very large, what you would consider more generic or product set that could be commoditized long-term. We're trying to shift that, and we are. From products that again, ultimately our biggest advantage is having cost reduction and having product in stock, over to products where we have an IP advantage and nobody can knock it off or compete with us. We're doing it on our gas and energy side. We just rolled out our first batch of stainless steel tanks. Tremendous positive feedback in the market around this. Now, this is just very early, but what we intend to do is replace our entire fleet with stainless steel. But we intend to go to state regulatory bodies, and we intend to ask them to keep the public safe by making sure that gas is being delivered in stainless and not carbon steel. This could be a huge opportunity to take over the entire market, but it's something that starts with a little bit of innovation. And again, that's off to the races. We're obviously partnered with C-Cell, who's a leading vape technology. We're one of 4 distributors for them. But again, there's some defensibility there. And then now that we finally built this network completely out and we have scale and we're connected with all these customers, we're getting more and more opportunities to take over exclusive relationships. So if somebody has a product, right, they're going to come to us and say, hey, I want to get this into cannabis, and I know you guys are the ones to come to help us. So expect for that percentage, and I don't have the numbers, and we'll work on that, but expect for that to only grow as all these initiatives are in effect.
Great. Thank you, guys.
Thank you.
Thank you. Our next question comes from the line of Scott Fortune with Roth Capital Partners. Please proceed.
Hi, thank you guys. Great quarter. Real quick, a lot of
Thanks,
questions
Scott.
got answered, but wanted to talk about kind of the sourcing, manufacturing improvements, kind of working with your manufacturers from overseas and kind of automation and improving your operational processes. Kind of touch base on that real quick.
Yeah, great question, Scott, and something we've obviously talked on previous calls. We're in a situation where, the car is going 90 miles an hour and we're, wanting to go faster. So we're having to get out there and we're having to fix the engine and improve it. So it's not easy to do, but we've been working on this steadily since last summer. And Rodrigo has been really the driving force behind that, which is why we were confident to be able to promote him into the COO role. We have basically upgraded a lot of our factories partners. We've gone from, factories that you can go to if you're just a startup off the street to now factories where, you can't even talk to them unless you're talking about a 10 million per month volume commitment. So we couldn't do it, 3 or 4 years ago, but as now we're at that phase where we're having to transition, and we have so many different products made from so many different types of materials that we have to start with, what the core products are, where we can get the most cost advantage due to our scale, and then we have to do it throughout the entire supply chain. So it'll be an ongoing process, but we've already had some major wins, and we have products that we've gotten cost reductions of 40 to 50%. We've been able to get products now produced in clean room environments, so they're coming with much higher quality, and there's much less aftermarket quality control that we have to do. It's an ongoing process. Supply chain's a big focus of ours. If we can execute on supply chain, then we're going to be able to win business, and we're going to be able to keep business. So it's critical. And then operational efficiency as well. Rolling out the WMS system was a big win here in our main HQ in California, and we're going to be rolling it out throughout the rest of our facilities by the end of the fiscal year end.
Okay, and then one follow-up on the energy side. Are you still continuing to expand geographically from that side, and just a little more color on the natural product side, going deeper into that?
Yeah, so energy and natural products remains a very exciting category for us. Obviously, I talked about the stainless steel tanks and the butane opportunity. Ethanol, we're starting to get some big customers on that front as well, mainly for CBD extraction due to the Farm Bill. We are expanding our hazmat, butane, and ethanol footprint. We are considering opening up in Michigan, both for warehousing and for hazmat. Canada, ahead of the ability for these companies to start producing oil-based products and beverages and edibles. We're considering opening up hazmat fulfillment up in Canada as well, in addition to warehouses. So there is some expansion we're going to do on all of those fronts, but we still need to get to scale in our core markets. We open up a facility, there's some fixed costs involved in that, and so that brings our margin down. Now, as we start to get scale in those markets, margins on butane should be able to reach 50% or higher, but we're not there yet in every market. So we're continuing to pump sales in the markets where we already have placements, and then we're looking at expanding as well into new markets where we see the opportunity.
Thanks. Great color. Thank you.
Thanks, Scott. Appreciate it.
Thank you. Our next question comes from a line of Alan Brochstein with New Cannabis Ventures. Please proceed.
Hey, guys. Congratulations on the continued momentum. And, Chris, I want to call out your effort. I really appreciate it. I know people weren't happy about the restatement, but to come in, to find something, and to address it so quickly is very commendable.
Yeah, appreciate that. I mean, certainly we obviously, whatever we see, we want to dig into, and I'll make sure that you focus on, high quality financial reporting.
So I have just a few quick questions. The first is, to somebody looking at a high level, not listening to the conference call, they might not understand the use of cash to fund inventory purchases this quarter, but it's going to lead to the question, so I'll ask it. You guys have raised capital over the last year roughly twice, and are you able to provide any guidance on when you might expect to need to raise capital again?
Yeah, I mean, we can't provide, clear guidance on that, Alan, but certainly a legitimate question, and I think that's, why I wanted to give the color on the call, just about the ways that we can, utilize, our vendors or utilize credit facilities or debt to be able to offset the working capital demands versus going to the equity market. And I think, that's a big factor just in terms of timing, in terms of when we're going to need to go back to the equity market. We certainly, would love to get a, $75 million credit facility from Bank of America at 6% interest to fund our inventory. That's not available today. So in absence of that, we've had some great conversations with some really strong lenders, that are getting appetite for working with a company like Kushco. And it's only a matter of time before we land one of these deals. And so expect to see, continued improvement in leverage on the credit and debt side. Can expect to see continued improvement in leveraging our vendor factory partners, especially as we get to scale and become a more meaningful player for them. And then, we're probably going to have to go back to the equity markets at some time as well, just being realistic. And the hope is that, we can do that as least often as possible.
Okay, so that leads to my second question about going back to the capital markets for equity, and that is the NASDAQ. Can you, we've been talking about this for a while. It's a little bit frustrating just to see that the NASDAQ is in an odd situation right now where it has several companies that are clearly violating federal laws and indirectly, like you guys are indirectly. Yet there's some companies that aren't permitted on it at this time. So can you clarify whether or not you guys have actually applied yet? I know you've been working for this. And then second, that's really it.
Yeah, and Alan, if you're frustrated, can you imagine how we feel over here? Obviously, there's a lot of hypocrisy when you look at companies that are listed on not just NASDAQ but NYSE as well, versus their appetite for listing other companies like us. And you can make obviously logical arguments, but at the end of the day, it's up to them. They're gonna make a decision if they're comfortable listing a business or not. We've spent a lot of time in identifying what those key factors are, what they're looking at when they're making that decision. One of them is, in my opinion, is they want to make sure that there's really, no outright illegality that is present, and we've made changes to our business to ensure that. I mentioned, restricting certain geographic areas from sales. We're also on the butane products. We're verifying licenses before we deliver. We saw some potential, indirect violation issues that we had there, and we quickly moved to fix it. And so we're doing everything we can. I can't comment specifically on the application, but we've been working. It's an ongoing process. We've hired external counsel. We've had dialogue with both exchanges. With Greenlane, obviously, everybody's asking, well, if they're listing, why aren't you listing? And it's not black and white as we've discussed. The other major difference is that 80% of their customer base is technically federally legal under tobacco laws. They're smoke shops and head shops, right? Whereas 80% of our customers are multi-state operators and cannabis brands who are legal at the state level, but they're federally illegal. And so that's a challenge that we have to work through. And ultimately, it's only a matter of time. I mean, I think the Safe Banking Act would really give them comfort in being able to list someone like us. We're going to continue to execute. We do, as frustrating it is to not be able to move where we feel we belong, we are doing pretty well on the OTC market, and the OTC market's been great for us. So, everybody's just going to have to bear with and trust that we're doing everything within our power to accomplish that goal.
Thanks for that. In addition to Greenlane, I was really pointing to the NASDAQ has let 2 SPACs on with very clear language, including most recently Tuscan Holdings, but before that would be MJ Freeway. Can you just clarify on that, though? Have you actually applied, or are you in discussions with NASDAQ? And if it's that you're in discussions, what would be the next step?
Alan, unfortunately, I can't comment on whether or not we've specifically applied to one of the exchanges. But, we remain in dialogue with both exchanges, and we remain in a position to be able to move to, whoever gives us the opportunity to list sooner.
Excellent. And then my next question, I'm glad to hear you interested in M&A, and you've laid out the case of how, at least for competitors that are not able to scale as the industry is scaling, how those might be, for customer relationships or maybe some different types of services and products than you guys have. But are you able to, at a high level, talk about what we should expect in terms of your M&A efforts? Are we talking about small deals, or will we see anything as large as CMP Wellness?
Yeah, I think you're not going to see really anything as large as that, just in terms of percentage to our core business, and that's due to our ability to get escape velocity and sort of outpace a lot of these other players. So when we look at deals, right, it's a lot less compelling than it was at that point, right? From a revenue standpoint, revenue percentage standpoint, a lot of these deals aren't going to necessarily move the needle for us. From a product standpoint, we're already getting best costs, and in a lot of instances, we're actually supplying some of our competitors with their products. So we're not able to really get a benefit there. And then the larger high-value customers are coming to us anyways because they're getting to a certain scale that they're outgrowing those folks. So we are getting more selective. The deals need to be essentially more accretive to make sense. And if we're going to spend our energy and effort to do it, it's got to be highly accretive from a revenue multiple and looking at businesses that can help get us toward our goal of profitability. So something that's EBITDA positive and pumping out cash. It also needs to be something that is strategic in getting us into a certain geography that we're not as strong and helping build out our infrastructure, or getting us into a new product set. And obviously, we've expanded by acquisition into vape. We've expanded by acquisition into hydrocarbon gases and solvents. We've expanded by acquisition into creative design services. We've also organically launched our own innovation arm, right? We could have done that via acquisition. We chose not to. We've also gone by joint venture into getting into the natural products. So there's a lot of more efficient ways that we can now start to get into these other verticals versus acquisition. But if there's a compelling story that makes sense on a creative standpoint, the deals are getting more, the prices are coming down. Let's just put it that way. So I think we will do some deals. I don't think they're going to be significant like CMP was in terms of revenue percentage.
Great. My last question is, Tilt Holdings recently bought Jupiter, and I'm just wondering if you could discuss kind of what that means for your company going forward.
Yeah, so Jupiter is one of the distributors of C-Cell products, and one of the original distributors, Mark at Jupiter, actually helped C-Cell create the products, and they've done a great job. They service the market really well. The main difference between us and Jupiter is going to be our product offering and our infrastructure. Jupiter operates out of 3PL facilities. They don't own or operate any of their distribution centers. They also primarily only sell vape products, whereas we have all of our different products, including products that are part of the vape supply chain. So you can't produce oil to put in a vape pen without some type of solvent, butane or ethanol, et cetera. You can't have a flavored vape pen without natural products, and you can't sell a vape pen in the marketplace without packaging. So we've built around vape a lot, and I think obviously that gives us a big advantage for a customer that's looking for a one-stop shop solution. So that's the main thing. The other challenge with them is I think they put a lot of pieces together, and I think at the outside, kind of looking in, trying to figure out where all those synergies are, and maybe there's a little bit of conflict as well when you're actively trying to sell products to multi-state operators, but you're also essentially a multi-state operator yourself. So we know those guys well. We have a good relationship with them. They're good guys. They built a great business. And as C-Cell distributors, we don't really look at ourselves as competitors. We work together in a lot of instances. And like I said, Mark specifically is a pioneer for working with C-Cell to help develop this product in the first place.
Within vape, do you guys break out how much of it is C-Cell related? Or can you give me an estimate?
Yeah, I mean, we're pretty established as a C-Cell partner at this point. The majority, almost all of the revenue is from C-Cell, although we do buy some batteries and other stuff from other factories. But we had some product quality issues with other factories. We quickly pivoted and aligned well with C-Cell because they just happen to have the best product quality in the market. It's the most scalable solution. And so, even though there's better margins to be made working with other factories. We're just all about product quality and keeping our customers happy so that they'll buy more items from us. And we found that it's much more effective to be able to do that with our partnership with C-Cell.
Thank you so much for answering the questions. I look forward to seeing you next week, Nick.
All right, thanks, Alan. Appreciate it.
Thank you. This concludes our Q&A portion of our call today. I'd like to hand the floor back over to management for closing remarks.
All right, thank you. My closing remarks, I'll make them really brief. We're very pleased with the revenue growth. We're very excited about the future robust pipeline for sales. Our cross-selling metrics continue to be a cornerstone of our business. We're very pleased to see customers that are spending over $1 million with us, buying on average 70 different SKUs from us. We think this makes us highly defensible. We think this makes our relationships much stickier. We're excited to be launching more proprietary products, continuing to shift away from generic products and selling more innovative products that we've created ourselves or acquired rights to. The innovation arm, Coletto, is pumping out very high quality work. We're also excited about a partnership we recently announced with iEcho, who's a pioneer in the biodegradable, compostable, sustainable arena. And, we know in this industry, it's an industry that's, very green in every sense of the word. And packaging has been, a black eye where, there's been a lot of waste. And certainly, we've taken the stance that first and foremost, it should be about compliance and making sure we have the right products that work for the products that they need to package and that meet and exceed the regulations in the states. And step two now is trying to transform those products into products that are also earth friendly. And we're really excited to be leading the charge there. And we expect some big announcements coming soon in that vertical. We're excited about the opportunity in these emerging markets with Massachusetts really gaining steam, Michigan, Midwest coming online, and Canada as well. We have the team in place, and as we're hitting scale, we're going to look to start capitalizing on that operating leverage. Looking at a macro level, cannabis is gaining momentum here in the U.S. and globally. We, at a local level, Massachusetts just opened their first store in Boston area. That's huge. Florida now is allowing flower sales. That's another big unlock on the medical side. California is taking strides to clean up the black market. At the federal level, the Safe Banking Act, the States Act all seem to have a lot of momentum. The new Attorney General is seemingly very willing to protect states' rights on this issue and potentially even putting some substantial legislation in place. We continue to be focused on corporate governance and financial controls. We're pleased to have made significant upgrades in our internal and external resources to be able to support the highest levels of best practices. Although we do believe our stock is trading at a much lower multiple than our cannabis peers, we're also confident that if we just continue to execute and stay focused on the long-term growth plan, the market will take care of itself and respond accordingly. We remain confident in our ability to continue growing our gross margins with our goal of 30%, and we remain confident in our goal of being profitable in fiscal 20. We're pleased to be able to raise our guidance dramatically to a range of $140 million to $150 million. And that's it for me, guys. And thanks again for your time. We really look forward to keeping you updated on our upcoming Q3 call. And we're going to continue to put our head to the ground and execute. Thank you. Bye.
Thank you. This concludes today's teleconference.